Richard Hunter of Wilson King Investment Management,
Simon.
and Nick Batsford, CEO of Tip TV.
Simon.
Coming up on today's show, there will be, of course, the inevitable discussion about Brexit, but then we're going to also talk about some of the things we need to think about after the vote, which we seem to have forgotten about over the past few weeks. But first, a quick look at some of those things that have been in the news. And we thought we'd go with some of the things that will be in the news after the referendum. Richard, can you cast your mind back to the days when we used to talk about things that weren't Brexit related?
Well, that's right. When we came into 2016, there was the list of things that we needed to consider, and all of those things seem to have been put on the back burner. There's a number of them, of course, and after we know the result of the referendum one way or another, investors are going to start to need to grapple with those things again. So obviously the first one would be something like China, for example, which of course caused a great deal of jitters in the market earlier in the year. The oil price has been fairly volatile during this period, but largely unreported. Obviously, it's been predicted to go a lot lower than it has done, but that's again one of those things that can be either positive or negative, depending on whether you're an oil company or a consumer or a manufacturing company which uses oil, of course. Then you've got things like the US election, which I suspect will get as much coverage as we get nearer the time as the referendum has, and that will be on both sides of the pond. As the world's largest economy, there will be no running away from that one. On top of that, of course, it's interest rates. Whether the economy in the US is kind of stable enough at the moment to withstand any sort of interest rate rises, and what sort of veracity and rapidity they might come along with. And then, of course, the good old basics of the fact that as we near the end of June, that's the end of the second quarter, and we need to start looking again about growth and earnings and how companies are performing. So with any luck, certainly within the next week or so, as investors, we can begin to go back to basics rather than just potentially over-concentration on one issue.
And I mean, one of the things we've had over the last couple of years, isn't it, is we've had this sort of reasonably good start to the year, you know, reasonably good early part of the year, although we've quite often had a bit of sort of January jitters. And then we've suffered over summer, haven't we, quite badly, running all the way into autumn. Do you think that the scenario this year looks a bit like all those other years, or do you think because actually maybe the start of the year has been a bit uneasy, people are going to be looking around for opportunities come the summer?
I think what's happened so far this year is, given the wall of worry that bull markets, as the adage go, have to climb, there has been more and more of a willingness from investors to do absolutely nothing. We know that there's a great deal of cash on the sidelines, and that's not only institutional and private investors, it's also companies who are, for whatever reason, withholding investments until some of these uncertainties disappear. This wall of money on the sidelines has been building up over the last 18 months, 2 years, so one would hope that in the second half of 2016, some of that cash begins to get deployed either into the market or into the sort of investment, which of course in turn will filter through to GDP.
And we've got a pretty benign outlook for interest rates now, haven't we? We've gone from the start of the year, the suggestion the Fed might raise four times, to now we might just see one or two. Yeah, I mean, where do you think that we stand on that, Nick?
I think interest rates will go up this summer, and that'll be it for the next 6 months. And I think it's extraordinary. We look back at January, we look at the volatility in the markets, and as you said, we were focusing on China, interest rates, presidential elections, and all of that's just been forgotten, hasn't it? Everything is about Brexit. Every single page of the newspapers, Brexit, Brexit, Brexit. And to a lesser extent, we now got the Federal Reserve saying, well, actually, we can't raise interest rates in June because we don't know the outcome of Brexit. It's just an extraordinary situation.
And when you look outside of that Brexit question, Richard, I mean, in terms of the companies that have been reporting over recent months, what sort of picture does that paint of the economy, really?
As a general rule of thumb, obviously some sectors aside, it's been a pretty good picture. The bank shares have been hit because of, again, the possibility of Brexit and you know, the ongoing problems around fines, for example, in the UK, and general regulatory pressure. But the results haven't been too bad. Now, obviously, the oil companies have been under the cosh, but they've been looking to very much slash their earnings and reduce their capital expenditure. Retailers, again, had a fairly mixed bag, but by and large, we're in a better situation economy-wise in the US and the UK than we were 2 or 3